The healthcare market has recovered nicely over the last 3 months. It's up 22%, and that's after underperforming the market for the previous 2 years, in part driven by the GLP-1 concerns and in part a slower rebound from COVID than expected, particularly higher labour costs and shortages driving up the cost base of many companies. So this morning, the healthcare team will run through 6 stocks that we want to highlight during the upcoming reporting season. First stock will be ResMed, and even though they've already reported their second quarter results, and that result was a good one, and the share price has rallied nicely, up around 7%, there are 3 things I want to highlight from that result. The real-world sleep apnea data that's been released, the upcoming trial results from Eli Lilly for their GLP-1 drug, and also the problems that Philips are having. So just starting with the real-world data that was released by ResMed at their quarterly result, where they showed that 500,000 sleep apnea patients, and it was shown that there was a 10% increased likelihood of patients starting sleep apnea treatment who are on a GLP-1 drug compared to those patients that weren't on a GLP-1 drug. So that's quite counterintuitive, but it sort of suggests that if you're going on to a GLP-1 drug, you're probably looking to resolve a number of other health issues as well. So that data we found quite interesting. The second point I wanted to make is the volatility in the share price of ResMed has been quite extreme. So if we go back to September 2021, ResMed hit a share price of $40. Fast forward to October last year, 2023, basically halved down to about $21. Since that point in time, it's rallied nicely up to around $28. We expect this volatility in the share price to continue because there's a lot of clinical data coming out in relation to these GLP-1 drugs. The one I want to draw your attention to is the Eli Lilly trial, which is expected to read out in April this year. And it's basically comparing the GLP-1 drug and trying to work out whether that reduces the incidence of sleep apnea. So depending on how that reads out, we expect some more volatility in the share price. But it doesn't change our long-term positive view that ResMed will continue to be a long-term growth story. The third point I want to just draw your attention to, and this was part of our original thesis on ResMed before the GLP-1 issue arose, and that is the problems that Philips were having. So overnight, the Philips has agreed with the FDA to a consent decree to halt all US sales. So they won't be selling any products in the US. There's no specific timeline here. However, we expect that it will take some considerable time to work through what the FDA require. So no more sales from Philips in the US. So obviously positive for ResMed. So the message with ResMed is that we expect the share price volatility to remain, particularly leading into this April result from Eli Lilly for their GLP-1 drug. So if you've got any overweight positions, there's potential to trim. However, our long-term thesis does remain intact, and we think it will be a long-term growth story. So that's ResMed. Turning to CSL, their first half result we expect to be solid. We're seeing a good return in growth for them. Their plasma collections are up. They've got some operational leverage through their cost base, and we expect the first half NPAT to be around about 13% up. Company has provided full year guidance of between 13 and 17%, and we sit at the top end of that. But the key thing, what we want to mention today, and you might remember Derek spoke about it last week when we launched the playbook, is that the company is expected to announce the phase 3 results for a clinical trial that they're running. It's to do with secondary heart attack prevention. This trial has been in the making for the last 7 years, and it's due to read out this quarter. So in terms of our probability of success that we've ascribed to this, Derek's put in there 50%. It represents about 8% of the price target of $328. So about $26 relates to this trial. And it is expected to read out this quarter. So within the next 6 weeks, we'll get a read on that. CSL spent over $1 billion, and as I said, it's been a trial that's run over the last 5 to 7 years. Next stock I'll turn to, and this is one we're watching on the negative side, is Ramsay. Ramsay have provided some revenue guidance only of mid-single digit revenue growth for the year. So although volumes have picked up post-COVID, the cost base of the company, particularly their labour costs, is slower to get back to a reasonable level. The results are second half skewed, so it's a 40-60 skew, and we're looking for EBITDA of around about $1 billion in the first half, and that is a flat result on the PCP and basically aligned with consensus. So that's the number we're looking for. If it's any weaker than that, there could be some downward pressure on Ramsay, but we're keeping a close eye on that. I'll just hand to Iain Wilkie to run through the next two stocks, Pro Medicus and Mach7. Thanks, Iain.
Thanks, Scotty. And just thought quickly following in your comments from Ramsay, it may be worthwhile slipping a comment in on Nanosonics now too. I mean, as you would have seen, big downgrade last week following a very weak half with the install base and upgrades lower, with management citing the hospital budgetary pressures. This is obviously a bit counter to what we've been seeing in many of the other hospital technology exposures, particularly in radiology, where ultrasound probes are obviously a critical component of, which are sort of showing volumes back at or above COVID levels. So to us, volumes are back, but the cost side of that equation with inflation is obviously causing some strain, as Scotty mentioned, and is potentially, as is potentially the case with Ramsay. So, just need to have in the back of our minds that there are some new products approved recently for high-level disinfection, which, while they don't have all the bells and whistles, and namely traceability into the hospital systems, they're likely to come at a lower upfront cost. I mean, will these products displace the Trophon over the long run? I doubt it, but I mean, it certainly warrants extra caution for at least the next little while. Also playing into this is the obvious quality of the machine itself. These things should have a replacement life cycle of about 7 years, but if profits are a bit tighter and the machine isn't broken, the hospital obviously won't be in any huge rush to upgrade. So, downgrades here for now, and we wait on the more detailed guidance expected out of the first half result. But just sort of thinking out loud, however, now that the downgrade is in, I've got no doubt the management will put their sales team on notice in between now and then. So, there's potential for better guidance than feared, and could be a trade in it, but I mean, for the long term, just happy to wait and sort of see a turnaround here first. So now just quickly on to Pro Medicus. I mean, I think the results will be good. New contracts dropping in the half, full half contributions from other larger contracts won prior, and volume increases. I don't think there's any doubt that it's going to be another consecutive record profit. I mean, my caution is just around the valuation and what it will need to do to maintain it. So my view is that it hits expectations, but to move the dial on the day, it would really need a convincing beat. So just sort of see some risks there and a potential negative surprise come result day. It is the highest quality business in my stable, but obviously just can't put my hand on my heart and say there's good risk return profile at 135 times 24 and still 100 times 25. Happy to trim and use it as a funding source up here, but otherwise you're just waiting for some weakness before stepping in. This one's out on the 15th of Feb and will be a closely watched result. Key here is the sales numbers, with consensus sitting around 75 mil for the half and expectations of EBIT margins just shy of 70%. And we're really just hoping for some commentary on radiology sales progress. Outside of this, you rarely get a whole lot of extra information from these guys. But regardless, a good result expected, but risk around if it's enough to prop up the valuation. Mach7. So this is a key pick for us in 24. Trading update released last week showing a big swing towards recurring revenue contracts versus its historical tilt to capital sales. Some loved it, some hated it. I'm in the former part of this camp. At the cost of near-term revenue recognition, this is about building a stronger long-term and more investor-friendly business, which is what this achieves. Looking forward a few years, we should see a smoother P&L and cash flow roll through, and I think this only helps with the optics. So, given the near-term sugar hit of those capital sales will now be spread across 5+ years, it obviously results in short-term downgrades, but upgrades on the back end with a higher loading rate for the recurring contracts over capital. But ultimately, I think anything which more resembles the Pro Medicus model is a tick in my book, and at 10% of the sales multiple of PME, I'm happy to back this one for the longer term. In terms of what I expect in the result, we should have the quarterly out tomorrow anyway, so most of the important bits will be known, so no huge surprises there on the half-year results day. But key here will be any new insights into the pipeline, which we expect to be strong, as well as some commentary around its operating cost base, which they've flagged as under review for a Titan, given the changing business model. So I just think it's a great buy around these prices. And over to Emily on Avita. Thanks.
Yep, thanks, Ian, and good morning, everyone. So our final call out is Avita Medical. So just a reminder, Avita is a regenerative medicine company. Its product is the RECELL system, which is a device that enables clinicians to produce skin cells using a sample of the patient's own skin. So think of this as a replacement for a traditional skin graft. So the RECELL product has historically been used in burns patients, but has recently received approval in full thickness skin defects, so trauma wounds, surgical wounds, chronic wounds, and this has seen the addressable market size increase by 10. So coming into the result, the headline figures for FY23 were already pre-released. So this included revenue of $49.8 million, up 46%, and in line with guidance, and gross margin expected to be around 84.5%, which is also in line with their guidance. So at the same time, they also provided revenue guidance for the year ahead, which is 78.5 to 84.5 million, or up 57 to 69%, which we think is pretty impressive and shows their confidence in selling into this new indication. They also announced a distribution agreement to commercialize PermeaDerm, which is a biosynthetic wound matrix in the US. This product will be complementary to the RECELL device and sold through their existing sales team. So with the headline results already pre-released and revenue guidance set for the quarter, what else can we actually expect in the result itself? Firstly, Avita will provide guidance around profitability and specifically when they expect to be profitable in 2025. This will likely drive increased investor interest in the name. We also expect to get an update on their commercial sales team expansion. So currently they have 70 sales reps, but we think this will likely move up to more around 100. This makes sense to us, just taking advantage of this expanded label for their device. On top of that, we should also get an update on the progress of obtaining FDA approval for their automated product, the RECELL Go. They'll tell us when they plan to submit the response to the questions that they've been asked from the FDA, and this will essentially start the 90-day clock. So we should get an exact date on the timing of possible FDA approval. And this will be a key driver of increased adoption moving forward and also a key catalyst for the stock. And then lastly, they should also give us a bit more color about that PermeaDerm distribution agreement. So in summary, plenty of news flow still to come, which despite pre-releasing, we have highlighted this one as still a key to watch. We think there's large opportunity for the business to grow given the expanded indication and moving towards profitability. So just in summary of everything we've spoken about this morning, so at the larger end of town, Derek is recommending clients potentially trimming overweight positions in ResMed, just given some volatility around the release of the GLP-1 data on OSA in April. He's positive on CSL into the result driven by above market divisional growth and operating leverage returning, although flagging that the top line data readout for the phase 3 trial of their CSL 112 is expected this quarter, which he gives a 50% probability. Max 7 remains Ian's key pick with potential upside from recontracting and moving towards more of a subscription style model similar to that of Pro Medicus. Then we had Avita Medical, which I've just spoken about. And then on the downside risk, we flagged Pro Medicus, just given its valuation, and the stock is at all-time highs. And then lastly, Ramsay as a possible negative surprise candidate with a possible miss on higher costs.